Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I am Paul Winkler. Talking money and investing. And answering questions that you might have through, a lot of times people email us questions, or go to paulwinkler.com/question is a second way of doing that. paulwinkler.com/question. And sometimes people ask us questions based on some of the workshops that we do from time to time. If you want to check out some of the workshop and the material on the website, there's a ton of it out there, paulwinkler.com. And we have video and webinars on Social Security, on Medicare, on investing, on just all kinds of different things. And it's going to be getting even more so in the future. We're going to be even doing more of that in the future. So check that out. So one question that I had here, somebody asked me this question. They just sent me this, and it was on the why sitting on cash is hurting many investors was the topic. And we were talking a little bit about cash in a portfolio. You have different asset categories. You have stocks of different types, large companies, small companies, and you got value companies and growth companies and U.S. companies and international and emerging markets. And then you have different types of bonds in a portfolio. And I've talked a little bit about that over time. But somebody was asking a question and making a statement actually regarding just disagreeing with me. And, it's fine. I'm good. I'm a big boy. Disagree with me. But, the reality is that I'm going to use research and data, and I'm going to walk through the thought processes, because here's what it gets down to. When we look at investing and we look at the returns that investors have gotten historically, we talk about the Dalbar research. There's Morningstar's research on investor returns. There's a lot of research out there. There are behavioral scientists that actually look at investor returns and talk about it. Terence O'Dean from Berkeley is one of the big ones. And there you have a lot of these people that are doing this work in this particular area on behavioral research are looking at it going, how can we get investors to be more successful? We've got to help them deal with their cognitive biases. If we can help them deal with their cognitive biases, then maybe we've got a fighting chance to make them better investors. But cognitive biases, they're bears. They're hard because every ounce of our being wants to protect ourselves from risk. We want to protect ourselves from things that we see as, scary, the boogeyman. It's kind of like a lot of times what happens, it's kind of like a kid in a ghost costume, and he's got this, sheet over his head, and he comes popping out and he goes, boo, and we go, and then, then when we finally investigate it and look into it a little bit, we find, it's a little kid in a sheet. It's not that big of a deal. But, a lot of times what happens with investing is we can look at the sheet and we go, oh, that thing is scary. And what we do is we jump, but we don't know how to take the sheet off to see what's really going on. And that's why information is so important. That's why it is so important to understand and be educated about investing, because it is really easy to be pulled off track and thrown into a tizzy and make a big mistake with our investment portfolios. And this person was disagreeing with something that I said about why cash is hurting many investors, and said doesn't agree with my idea of sitting on cash. And he's talking about his wife's 401k having a return of only 2% over the past year. Now, if that was the return over 8 years, that's what he said here. That's a pretty bad return if it's actually 8 years. Now, if you look at a few year period, especially with 2022 being such a tough year in the stock market, yeah, you could probably find shorter periods of time where the return was maybe 2% or even lower, depending on the period of time you're looking at. So no question about it. Now, if you look at the past 8 years, if you had just a well-diversified stock portfolio, I just look at my own stuff and what the returns were in stocks over that period of time. Well, you had a rate of return of a growth rate of about 100%. 99 point something percent is what I was looking at for U.S. section of a portfolio, well over a 50% return in international. International didn't do as well, but if you look at the preceding period in time, international did way better than U.S., and that's why we own them both, U.S. and international. Now, is that lower than historic norms? Yeah, if you annualize that, you're looking at about a 9% return in a U.S. section of a portfolio. Now, some areas were higher than that in U.S., like S&P 500 had a higher return. Some areas were lower, smaller companies, but historically smaller companies do better. But there are times when large does do better than small. And that's why we own them both. That's why we diversify in all those different. You just can't predict it. You don't know what's going to happen next. But you look at that return and go, wow, that wasn't 2%. Number one for 8 years. So I don't know what the time period is. I don't know what the situation is for this particular person. But I want to just concentrate on the concept here. I'm seriously thinking about taking my portfolio out and putting it in CDs since I'm 75 years old. Okay, so number one, if we look at this 8-year period, that's what I just did, is I ran some statistics and I used different asset categories. I used large value companies. I used small and growth, and I was just breaking up it over that period of time. But I just want to focus on treasury bills because that would be a close proxy to like CDs or something fixed or something that's guaranteed, something that I know will not drop down in value from a nominal standpoint. Now that nominal means let's forget about inflation and act like there's no such thing as inflation. From a nominal standpoint, we don't have a negative rate of return, going back through history. But what was the rate of return over 8 years for that? And the answer is that the rate of return was about 1.2% from September of 2015 through where we have data in the software that I use through the end of July of 2023. So it's 1.2%. So I'm going to move everything over to something that over the last 8 years had that rate of return when, as I said, if you were well diversified in U.S., it was 100% return approximately, right? That doesn't make any sense. But, remember, investing and humans don't use sense. We make decisions. Remember, I was actually watching, listening to a podcast this week about that. And this guy was talking about dealing with anxiety in general. Had a great thing on anxiety. Matter of fact, I probably need to talk about it a little bit in just a bit. But he was just talking about how, we try to deal with anxiety using the cognitive part of our brain. We try to outthink of it. And he says, period, end of sentence. You will not outthink anxiety. You won't think your way out of it, he said, because it comes at you at an emotional, just this visceral level. And that is that your emotions and your instincts were designed to keep you alive. They were not designed to think. And so what happens, we react to things, we're reacting at that particular level, and thinking has nothing to do with it. And he's absolutely right. I mean, the parts of our brain that deal with emotions, the medial part of our brain that deals with emotions, it has a connection to the front part of our brain, but it's tenuous many times. Especially when you're younger. Now, this is an older person, but when you're younger, it's really tenuous. Matter of fact, guys don't have fully developed brains until they're 27 and girls till they're 25. And it's a challenge. Any of you that have had kids, that's a challenging age because they're not thinking. What are you thinking? I wasn't thinking, is their answer. So if you look at this and you say, wow, okay, so I'm going to move things from this one asset category to this cash because now that cash thing or that CD is paying a higher interest rate. You've got to ask yourself this question: why is the CD paying a higher interest rate now than what it did over the past 8 years? And the answer is inflation. There is a very, very high correlation between interest rates and inflation. And incidentally, what is the reason why we invest in the stock market? Why do we invest in the stock market? I hope you are screaming at your radio, Paul, it's inflation. Because if we look at fixed income investments throughout history, we see no return after inflation. Matter of fact, I was talking to somebody, we were talking about gold this week, and I made that comment. It says, what's the rate of return? Well, you could buy a good men's suit for an ounce of gold 100 years ago. What can you buy today? A good men's suit for an ounce of gold. What's the rate of return, Ben, after inflation? Nothing. Okay, but the standard deviation of the amount of volatility is huge in gold. So just perish that if you're even thinking that that's your solution for inflation protection is gold. No, it's not. But stocks have always been that because what inflation is, of course, is prices going up, and we own the companies that are raising prices, and that gives us protection because their land values, their property, their assets, their inventories go up in value. You know, if I have inventories for a company, and that's part of the valuation of my company, I have inventories, whatever it is I sell, I have some of that ready to be sold, my inventory. And all of a sudden you have inflation, it means I'm going to raise the price for that thing if somebody wants to buy it from me. So hence what happens by definition, if that's part of the value of my company and the price is going to go up on it, what's it do to the value of the company? Eventually it ends up in that higher valuations. And so hence we look back at history at the highest returning periods. When we look at stocks, it's always been through inflationary periods. Now, you can have a dip down just before an inflationary period. Could be what happened 2022. You think about it, why'd the market go down 2022? And not just large stocks, but small and, differing amounts. Differing areas went down in differing amounts, but they went down. Why? Maybe in anticipation of that. And because inflation could be a negative in the short run because nobody wants to raise their prices first. So hence, the reason they don't want to is because they could lose market share. So, if we look at this and we say, well, but I'm 75. Let's bring us back to that. Now, I did a whole workshop on this. And the whole workshop was on the idea is I'm too old for this. That was the title of it, because this is commonly what people do is as they get older, they go, I don't want to lose this. And you go, well, what's your fear? The market will go down and never come back. And the way I answered that, of course, so if the market goes down and never comes back, that means earnings went away and they never came back, which means if the earnings have gone away, then that means taxes have gone away. If taxes have gone away, that means the government has gone away and your FDIC insurance isn't worth anything. So let's just put that one to bed. But the other thing is this. I'm worried about it going down. Well, if I'm 70, I'm worried about it going down. I'm worried about running out of money. Well, if it goes down, if we look back through market downturns, how long do they last? You look at 111 days as the average downturn before it comes back, but maybe a little bit longer than that, maybe a year, maybe 2 years. But if it takes longer than that, or if it takes, that amount of time, let's say, 1 to 2 years or something like that, and you don't have that much time, then let's face it, the money isn't for you anyway. It's for the next generation. And is a portfolio of a bunch of CDs an appropriate asset mix for maybe, let's say, 40 and 50-year-old people that are going to inherit the money from you to inherit? Does it make sense for them to have a CD portfolio? No. So if we look at that, we say, well, if you don't have that long of a period of time that you're going to be on the planet, then the money isn't for you. And the reality of it is, I don't know what the asset mix is, but for this particular person, but probably a significant amount of bonds and fixed income investments. We already have a significant exposure to fixed income, most likely at that particular age. So therefore, that money is just fine taking care of you forever, however long you have, if it's not that long. But if it is a longer period of time, then you've got a problem on your hands, because if you don't have any stocks or any equities in your portfolio, you're really putting yourself at huge risk for inflation. And then you might ask a person such as this, go, well, what's your biggest concern? I mean, what are you really, really worried about? And quite often they'll go, I mean, look at the administration, look at the government, look at, what's going on in Washington, D.C. And, they'll go on, let them rip, let them go on. I like to hear what they're worried about. What is your biggest, hairiest fear? and it's normally that, right? So you're really concerned about the government, and now you want to put all your money in an investment that is backed, and you're basically it's backed by, and the investments, which are dollars, right, are printed by who? The government. So aren't you going and concentrating all your assets with an entity that you just told me you don't trust? So remember, none of this is ever rational. It's never rational. These fears that people have. If we're dealing with our rational mind, we wouldn't be having these types of conversations, because we know intuitively that diversification is about the best thing that we got, getting us to safety that there is. There is no such thing as safety in the world. And recognize also, the other thing that we want to recognize is that maybe you have been an investor. Maybe you've been an investor that has spent your entire life, in your investing experience, maybe engaging in trying to pick which stocks are going to do better than others, what areas of the market I ought to be in, what areas of the market I ought to stay away from. Maybe you're an investor that has, tried to move out when you thought things were a bit scary, move out of stocks, move back into them when you thought things were going to be really good. In other words, market timing. Or maybe you've been engaging in tactical asset allocation, moving between small companies and large companies and value companies and growth companies and U.S. and international versus what you thought was going to happen or what somebody else thought was going to happen. Maybe that's the legacy that you've had thus far. And what we know is that our kids pick up on what we do, and they tend to repeat what we do. We know now because of, the research on the scientific research that we have mirror neurons, and we tend to mimic what we've seen before. The example I've given on here before is the kid that plays baseball, and his younger brother just watches him for several years, because he's too young to play. And then when he gets a chance to play, he's better baseball player than his older brother was. Why? Because he vicariously played baseball just watching. So what ends up happening is that we do that with our parents. We say, well, how do you deal with this situation, mom or dad? You don't even have to ask them. You saw them deal with it when you were growing up. You watched your parents do the things that they did with each other, how they resolved conflict with each other, how they handled money, how they handled work stress, how they handled mealtime, how they handled raising you as a kid, let's say. Well, don't you think that our kids watch us no matter what age we are? I think about, what did my dad do when he was thinking about, when he was at this stage in his career, what was he doing? That's a question I ask myself all the time. What was he doing? I was talking to somebody about my uncle a little bit earlier. What he did, how he handled his business and how he worked in it and what he did and the decisions that he made. There's always somebody watching us, right? Now, if you're that investor that engages in these activities of stock picking and market timing, and that's where you've been forever, and you start to recognize that it's not really a great way of managing money, maybe you can be that person that makes that change in your family and changes things forever into the future on how your kids handle money. People watch us. It's really important that we don't mess this up. And when we look at the desire to move a portfolio around based on fears, recognize that your instincts and your emotions are not your friend when it comes to investing. They never have been. They're not well connected to the cognitive part of our mind, the part of our mind that should be thinking and making decisions based on fact and rational processes.